My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. Other people want to make friends. I'm just trying to make you some money. My job is not just to entertain, but to educate, teach, put it in perspective. Call me, 1-800-743-CNBC, or tweet me at Jim Cramer. Okay, we know inflation's raging right now. We hear from all the companies that buy raw materials, from fatty oils that you eat to light, sweet crude that you burn, natural fruit or natural gas. It's all soared in price. This morning, we got a consumer price index number that it documents what I call
the house of pain.
Inflation, with 5.4% increase. Despite the headline, the average has barely reacted. Down, edging down 107 points. S&P slipping 0.35%. NASDAQ declining 0.38%. And most of the time, the NASDAQ was in the black. I mean, this is in part because we certainly saw this one coming. Still, prices for almost everything the consumer buys have gone up. From used cars, because automakers don't have enough semiconductors to boost production of new ones, to packaging, to freight, and so many other ones. So, okay, what do we do? What do you do when you see the biggest inflation spurt in 13 years? Do you run for the hills? Do you panic? Do you dive? Do you get under the desk because they're shooting you? No, simple. Buy. You buy big tech because it is immunized against the two scourges that Wall Street's worried about: rising raw costs and the possibility of interest rate hikes from the Fed. If Jay Powell suddenly gets cold feet and decides to taper or even tighten ahead of the mythic plan, I don't think Powell's going to change the stance. But there are a lot of money managers who disagree, and they're more important than I am. And when we see a number like this, well, they sell a lot of other things. Sell. And they buy tech because they want to be in
house of pleasure.
Let me put it like this. There are some huge patterns that keep repeating themselves in this market. And if you get a sense of them, and I know I can help you see them, it's much easier to pick winners. It's the worldview. It's the stock whisperer. This spring, we had a furious rally in the industrials. You heard lots of people talk about the market pivoting from growth to value. But that was a canard. That was a dumb way to look at it. That confused you. That was just Wall Street gibberish. The reality was that beaten down cyclical stocks or industrials were coming back thanks to a resurgent economy. Take a look. This is the prototypical one. Freeport-McMoRan, FCX, largest copper mine on earth. Is Freeport really a value stock? Well, wait a second. It was certainly a value stock here when it was traded $12 last August. Okay, you got me? But then it rallied to 46. Hardly value, yet the people on TV kept saying it's value. Value here. Stupidity here. More accurately, it's a boom and bust stock that's hostage to the broader economy, and I've known that, and I've lost a lot of money on it when I got too complacent, which is what people did when it was up there. See, as long as the Fed was eager to keep interest rates low, Freeport and its compadres could keep climbing. But then on May 12th, we got a similarly hot CPI number, and the industrials all got obliterated. They really haven't recovered. Since then, money has flowed back into the highest growth stocks. Why? Because money managers figured that the Fed would have to slam the brakes on the economy to stamp out inflation, and hyper-growth tech stocks are actually what works best during a slowdown because they do well anyway. It's all about anticipation here, not a concurrent reaction. This has a real bad feel to me. Sure enough, we got the same scenario this morning, albeit with a slightly higher CPI number. And what happens? Those same tech stocks were from the get-go because people remember the pattern from May 12th, at least at first, before giving up their gains. Sky-high inflation was pretty baked in. The last hour was what I call sloppy. I think the techs can resume their climb in the near future. Now, I want to look at some of the winners today, okay, because they really tell you a lot. I'm going to start with Alphabet, the parent of Google, all right? Now, we don't talk about this gem of a stock nearly enough, even as it's up 45% for the year. Some of that's because the principals are painfully shy. Some of it's because they don't particularly care about ginning up good publicity. They don't think it does anything for them. Think about what happens to Alphabet when there's inflation. Oil and gas prices have skyrocketed, right? You agree? But does Alphabet have an energy problem? I want you to do this after the show, not now. Go to the Google search page you visit a dozen times a day. Check out the bottom. No one looks at it. Carbon neutral since 2007. I don't think they have an energy problem. Does Alphabet have a problem with plastic and packaging? So sky high. No way. See, they got an asset-light, brain-heavy business model. How about rising freight costs? Oh, man, they hobbled so many companies are short truck drivers, like all those consumer packaged goods places. Do they have to deal with the port slowdown? Maybe they got some important materials waiting on ships from China. I don't know. Where one of the chief ports has been struck by COVID? Of course not. Alphabet barely ships anything. Are they bothered by the force majeure of the key elements in paint? Now, they don't paint anything. I mean, I've been out there. I mean, a lot of the walls they're not even painted. It's what I call a bonanza of non-inflation. Then there's Microsoft, which broke out today for much the same reason. I mean, you think something good happened here? No! It was more of a celebration of nothing, as Microsoft has barely any meaningful raw costs. Now, we know that Conagra, the packaged food company, had to cut numbers this morning. Why? Large part because of rising costs, especially for edible fats and oils. Now, I am not seeing that kind of pressure at Microsoft. Maybe in their cafeteria? Now, we've heard many companies talk about a shortage of truck drivers. I doubt Microsoft has any drivers, except for maybe people, maybe guys shuttling people around the campus. How about Apple? It's got a fabulous brand, perhaps maybe the best in the world. Best customer service. It's got the highest score, all that stuff. Goldman Sachs reported today, and they spoke lovingly of their partnership with Apple on their credit card. Then later in the day, it was reported that these two have a buy now, pay later plan. Oh, do people love buy now, pay later? And it's in the works. I think Apple's got a lot of upside with minimal downside. Unlike Apple and Microsoft, though, it makes lots of hardware, which means raw costs are an issue, most of the materials. But Apple's customers love their products so much that the big wireless carriers have to subsidize the costs as they fight each other for market share. Did you notice T-Mobile's up again today? Have you noticed that AT&T never does anything? I wonder why that is. Randall Steven? No, never mind. That's the old days. Not much in the way of supply issues at Apple. They've been loyal and large customers for tons of expensive materials, but their products are seen as necessities, not luxuries. Which brings me full circle to the actual winner today, to PepsiCo. Ramon LaGuardia, smart fella. This morning, the soda and snack maker reported a monster, truly monster quarter. I was quite surprised when I saw it. I saw it at 6:03 a.m. I said, got to be a mistake, got to go through this, no mistakes. It did have plenty of inflation throughout its entire supply chain. So then how the heck could Pep have a good quarter? Simple. Because the other thing besides tech that works are beloved brands that allow them to raise prices ever so slightly and pass those higher costs on to the consumer. The stuff will still sell. And that's a big reason why Pep could rally 2% today. And unlike the moves in Alphabet, Microsoft, and Apple, that move is going to have some staying power tomorrow, I believe. Numbers have to go higher. Still, not everyone is like PepsiCo. Many companies can't afford to pass their higher costs on to the consumer because people will rebel. And that's going on all over the country. By the same token, not everyone can handle a sudden rise in interest rates, which is what many money managers are betting on, too, even as I think it's very unlikely. So here's the bottom line. If you want one industry that's immune to both inflation and a Fed-induced slowdown, well, it's big cap tech. Meanwhile, we've heard from a dozen companies so far in the last few weeks of the kind of pre-earnings season, and nearly all of them talked about how they had to spend lots of time and money going where? Going digital. So if you're really worried about this red-hot inflation number, why not just buy the digitizers?
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.